So my next guest, Justin Dixon, he's going to talk to us about how he was in the right place at the right time for years straight, had the skill set and knowledge base needed to take advantage of these opportunities that were jumping in front of him, starting two different businesses, recruiting people for companies, right, recruiting business, as well as real estate investment and syndications, basically straddling both industries or hopping back and forth as the opportunities and landscape change in each one. It's a really great story. You know, if you read between the lines and pay attention to the details, you're going to see just a brilliant manipulation of identifying and taking advantages of opportunities as the landscape and economy change, and leveraging your skill set and knowledge base in doing so. So great listen. Excited for y'all to hear this. And so let's jump in. Justin, welcome to the show.
Yeah, man. Happy to be here. Excited.
Cool, man. So look, I got I've seen a little bit of what you're doing there, and it's, you know, to me, from where I'm looking, it looks like you got a pretty long history in recruiting, and you're still doing that. And at the same time, you kind of got like this real estate syndication thing going on the side, which are two like really ambitious things to be doing. And then at the same time, no less, man. So I'm really excited to hear your story. How did you get into, I mean, it looks like you've been recruiting longer. So how did you get, segue into being a real estate syndicator from doing that? And how are you managing both? That's what I'm most curious about. Take me to the beginning, man. How,
Yeah.
What was that time when you were doing, recruiting and then getting into syndicating?
Yeah. So I fell into recruiting just kind of right out of college, just fell into it. Didn't really know it existed as an industry and haven't gotten out of it, rightly or wrongly. But it was 2018. I was working as a corporate recruiter, so working in-house at a big Fortune 500 company, and never had exposure to real estate. At that point, my wife and I owned a condo in Philadelphia, but that was our only like real estate experience. And then I found the book Rich Dad Poor Dad. I was listening to it on my walk to work. And when I got done with it, I was like, it was a light bulb. I'm like, we're not doing it right. We need to figure out a different way to do it, because I grew up in a middle class family in a rural part of Pennsylvania, and the ethos was get a good job with a good company, invest in 401k, and hopefully you have enough money when you're 65 or 70 when you retire, right? And so that was the path I was marching down. My wife and I are both W-2 employees. And the book just kind of was like, wait, there's another way to like live life and go about this. And hopefully maybe I don't have to work till I'm 65 to have enough money to retire. So it was a little bit of a scary moment, because I immediately had this kind of mindset shift. But obviously I was married, so I was hoping my wife would be on board with all of this. So I just asked her, I was like, hey, can you just read this book and tell me what you think? And luckily she's a really fast reader. So she read it in like a weekend and had the same light bulb epiphany moment of like, what the heck are we doing? We need to be thinking about doing things differently. And so that was the beginning of our journey, was just this like book that opened our eyes to another way of investing, other options to invest, ways to generate income while you sleep, passive income, all those keywords. And so that was the start of our journey. And I can keep going, or if you want me to pause there, but I'm happy to keep going to kind of what we're doing now.
No, this is good, man. What's I'm curious where you saw the light with that book, like so many people have. So, and you had the condo at the time?
Yeah, so we lived in Philly, and again, we were like, hey, we are going to be here for a while. So instead of paying rent, because rent was a four-letter word back then, not a good thing to be doing. You're just kind of throwing money down the drain, so people say. So we were like, hey, let's find a condo, and so we bought a condo for ourselves, our primary residence, and then we read that book, and we're like, okay, well, we just sunk a bunch of our savings in that book. Or into that condo, and so, but we had some money. I've always grown up as a budgeter, a saver. I took that from my dad, and so I had at that point I had a little bit of money in the bank, and we're like, we need to find something to invest in. So we started looking in Philadelphia, and I didn't want to go down the single family investment route. I felt like that was too risky from the standpoint of only having one unit. So if that unit was vacant, you're on the hook for the full mortgage. So I was like, well, let's see if we can find 2 to 4 units. That way, at least we can spread our risk for our first investment amongst a few different units, a few different tenants. And we looked in Philadelphia area for probably 3 or 4 months, put in a couple offers, had a couple accepted, pulled out of a few because of inspections. And then I just randomly Googled top real estate areas to invest. And this is 2019. So the normal locations came up: Texas, Florida, Georgia, but then Pittsburgh, Pennsylvania popped up for whatever reason. And my mother grew up in Pittsburgh. Obviously, Pittsburgh is not in my backyard, but I had some affinity with the area. So I Googled real estate agents in Pittsburgh. Literally the first person I talked to, I explained who I was. I said, hey, I'm a new investor. I have a little bit of capital. I'm looking for an agent to partner with that they can help me find deals. And this guy was like, cool, I'm an investor myself. I'm pulling up to a flip right now. So let's rock and roll. And I would look for deals on the MLS or kind of on, Zillow and all of that. He would go look at the units, the properties, take video, and essentially show me what the insides actually looked like, and gave me some recommendations on, hey, this one's good, not in a great area, et cetera. May of 2019, we closed on a duplex in Pittsburgh, and the first time I saw the property live and in person was during the inspection. So that was our first property that we bought, kind of sight unseen, so to speak. We still have it to this day, and it's doing pretty well. We had some hiccups with COVID, just with tenants paying rent and all that stuff, but I underwrote it to have enough juice in the deal to afford a local property manager. So I don't deal with the tenants, the toilets, the trash, the midnight calls, any of that. I have a property manager that handles all that stuff out in Pittsburgh. And, the 15th of every month, I get a little ding in my inbox that says, hey, we've distributed some capital into your account. And so it's all gravy at this point. But that was our first deal, and that was May of 2019.
So that's awesome, man. Getting into it like that. Just kind of, when did you finish reading that book?
It was probably mid to late summer of 2018. And at that point, we were like, hey, we had our mindset shift, but we didn't have any idea of how to get started. So we stumbled upon Bigger Pockets and other podcasts. And so we were just consuming a lot of content, a lot of podcasts, a lot of books, a lot of, YouTube and all of that, which was good and bad. It was good because it just gave us a lot of information on the different aspects of real estate. The challenge that we saw before we invested in our first deal and after we invested in our first deal was the shiny object syndrome. We were chasing, every episode of the Bigger Pockets podcast had some expert that was really experienced in one aspect or one area of real estate investing, whether they were single family, BRRRR, short-term rentals, multifamily, whatever. And so, for about 6 months after we bought that first deal, we were just like, ooh, let's try this, let's try that. So we sent mailers out. We did all of the things. And when it didn't work in 2 seconds, we moved on to the next thing. But then at the end, go ahead.
Was that like direct to seller marketing that you were trying to do, trying to get into wholesaling, stuff like that? Okay.
Yeah, we didn't want to get into wholesaling necessarily. I think we probably would have done that if the opportunity presented itself, but we were really trying. The mailers were around. We were reaching out to 2 to 4 unit owners that we bought lists for and just said, hey, we're willing to buy your property, kind of a thing. We got a few hits, but again, we literally tried it we probably sent out 200 mailers and we talked to probably 4 or 5 people. So we definitely didn't do our, put in enough time and effort, but yeah, we were just trying things out. And then near the end of 2019 or kind of middle of 2019, after we bought that deal, I kind of started to really think about going bigger and syndications. And it was about that time where I was ready to kind of jump out and do my own thing. And so after we bought that first deal, we moved out to the suburbs. So we kind of had an entire lifestyle shift also. So we owned this really nice condo in Philly and we were living downtown. And so we were like, okay, if we want to have me quit my job to start my recruiting business full time and to focus on real estate, we need to shrink our expenses as much as possible so that my wife's salary could pay for all the bills, pay for our lives. So at least our lives wouldn't feel like they changed a ton. And so this is around the time where all my friends were buying houses, moving to the burbs, having kids. So they were going down that normal white picket fence W-2 lifestyle. And we were doing the exact opposite. We were renting out we moved out to the burbs into an apartment, a much smaller and older apartment, because it was cheaper. And we only had one car, so we didn't get a second vehicle. And we rented out our condo. And at this time, it was August of 2019 that we kind of started this transition. And then January of 2020, I had the bright idea that was the day and the time that I was going to quit my job, a very stable 6-figure salary job as head of recruiting for a wealth management firm, to just jump into the abyss of starting a recruiting business and a real estate business right as COVID was starting. So
right.
That was a trial by fire, so to speak.
I bet, man. Oh, man. And well, you made it out alive. You're still doing both, man. So you decided you bought one duplex, right? And which took you a year to do after the mindset shift to just get on the. And I found myself, man. I feel like the MLS is like now at this point just overlooked by real estate investors.
Yeah,
because there's deals on there, man, and like everyone's looking for this direct to seller stuff, and they're busy with that on the phone all day, setting up their text system, sending out their mailers, and I'm like, here's something that just popped on the MLS. Looks great. Yeah. Let's put in an offer, So you got that one deal, and your next thought is like, cool, I'm ready to syndicate. And 6 months later, January hits, and you walk away from your job. January 2020 to start 2 new businesses. How'd it go with? Man, I don't know which string to pull on first. So what happened? What happened first, man? Did you syndicate a deal, or did you start the recruiting business, or did neither one of them even get off the ground before it's like March 2020 came around?
Yeah, so luckily I had been doing recruiting for 10 plus years at that point, so I had a good network. And January and February were still okay. Like COVID was a word that people knew, but it definitely wasn't impacting our lives like it did, a month later in mid-March, right? So when I jumped out, I already had kind of irons in the fire and had companies that said essentially, let me know when you leave because I can use your assistance because I had a brand in the Philly market. So January and February and even early March were kind of fine. They kind of were a little bit what I expected. I picked up some hourly consulting. I did some normal kind of contingent recruiting. So that was fine. And then from a real estate perspective, I realized pretty quickly coming out of 19 into 20, I started to underwrite these 100+ unit apartment complexes and realizing that it's way more complicated to understand and underwrite these bigger deals, way more difficult than it is to underwrite a 2 to 4 unit a complex, right? So, and I also realized the one thing I liked about syndications was that I didn't have to have a ton of my capital into the deal if I was the deal finder, right? I could say, hey, I've got this great deal. Who wants to, invest with me and build a team? But I realized also I didn't know and have an ecosystem of other real estate investors that wanted to kind of go along their syndication journey. So February 2020, I got into a coaching mentorship program because also buying these bigger deals, you have to have net worth, you got to have track record with the brokers and the lenders. So, and I didn't have any of that. And so I joined this mentorship program called Think Multifamily. And that was my entry point into really digging into underwriting. And 2020 being what it was, recruiting was, after March, it kind of fell off a cliff, was very, very slow. I got through that year with the help of some bourbon, which was necessary throughout the year. But I used that time that I would have been recruiting I underwrote over 200 deals that year myself, submitted a bunch of offers just to kind of get the motion and understand really how to underwrite these deals and understand how how they operate, what they look like, et cetera. And we also passively invested in our first deal that year. I also wanted to invest in a deal ourselves so that when I started to bring deals out to my friends, family, my network to invest with me, I wanted to say, hey, I've already invested in a deal. Here's what I'm seeing. Here's the process. So I wanted to go through that motion. And when you get into the real estate world, you realize there's so many opportunities that people don't normally think about to invest, like using an old 401k, rolling it into a self-directed IRA and investing with that capital. Sure. I had two previous companies that I'd worked for that had decent amounts of money in the 401k, and so did my wife. So we just rolled one of them into a self-directed, and that's how we invested in our first deal. And actually, that deal just sold late last year and did really well.
That's a quick exit.
Yeah, well, it was one of those things we kind of, you time the market a little bit because 2021 and 2 were fairly hot. And obviously this year has been slower just because of the high interest rates and all of that. So,
sure.
So yeah, I used a lot of 2020 to really hone my skills on underwriting and really learning the syndication world so that I was prepared for once COVID kind of settled itself out and people were still, starting to invest again and all of that.
So you LP'd on a deal in 2020 then.
Yep.
You took your, just, I want to make this clear for people too, because I can't stress this point up. So many people don't know about it. You had two old 401ks sitting with some employers, just doing their thing.
Yep.
And you took those and essentially were able to take complete control of them and put it into a multifamily, a large-scale multifamily investment deal, a private investment, right, put together by other people on the streets that, the only way you get to know them is, if someone introduces you, kind of.
Yep.
Like that type of investment. You would take that 401k and put it in there and essentially still enjoy all the same benefits that you get with 401ks by converting it to a self-directed IRA.
Yeah, exactly. And we actually did, so I took one of my old so we used there's two types of self-directors that you can use, at least that I'm aware of, right? You've got your custodial account, which means that you actually they have to kind of approve the investment, right? Because you can't invest in everything with your self-directed IRA. You can't invest in a property that you actively participate in. So you have to be a limited partner, right? So one of the accounts that we used for our first deal was a custodial account. So we had to submit all the PPM documentation. They had to sign it for us and all of that. And then I learned about the checkbook IRA, which essentially is, you can control your destiny with that, with the simple writing of a check. So I converted my 401k into a checkbook self-directed IRA account. And we invested in our second deal in early 2021, I think, with that. Or it might have been late 2020. I can't remember at this point. But yeah, so our first two investments that we did as LPs were through self-directed. And then 2021 was when we started to raise some money and participate as a general partner on some of these bigger deals.
Nice. So 21, you start getting into actually being a co-GP, right? Yep. I take it.
Yep.
So how'd your first deal go?
Yeah, so it was nerve-wracking, to be completely transparent, because I had never, I didn't think I wanted to do that part of the business because I'm an introvert by nature. So asking people to invest in a deal that I'm bringing them, and I'm not asking them for 10 or 15 bucks. I'm asking them for, 50 to 100, 150, depending on what they're comfortable, investing. So that was a nerve-wracking proposition to come to some folks that I knew that were friends, some that I knew that were savvy investors, and to say, hey, I'm investing in this deal. And that was the good thing, is I had the capital to invest myself in the deal. So I essentially said, hey, here's why I like the deal. It was actually outside of Kansas City on the Kansas side. And the benefit of that deal, it was 140 units, I think, across two properties that were right next to each other. But the group that I'm in, one of the general partners that found that deal also bought a deal the year prior, right down the street. So it was we already had a proof of concept in the market. It was a very similar property. We were going to use the same property management company, et cetera, et cetera. So the story that I told investors in my kind of presentation to them was a pretty straightforward story. We have this property A that the team bought a year before. Here's where rents were. Here's where they are now with this type of investment. We feel like we can do the same thing. And so, I didn't raise a ton of capital in that first deal, mainly because it closed literally it filled up. I can't remember the number that we raised as a collective, but it filled up in like 4 days. So, but this is at the point where people had some pent up demand from 2020, not doing a ton of investments just because there wasn't a ton on the market. And so it was like, hey, we put it out to, our networks, and literally we were fully subscribed, like I said, in like 4 days. So it was a good experience from like I crossed that threshold. I was able to raise a little bit of money and kind of get that first co-GP check mark on my track record. The deal has had its ups and downs throughout the last 2.5 years, but we're on the up and up at the moment. So it's been an okay deal. It hasn't been a rock star like we thought it was going to. There's been some things that happen in the macroeconomics landscape that have caused some issue because we were on variable rate debt, and that was way before people thought about rate caps and all of that fun stuff. So, our debt service went, I think it at least doubled, from the time that we bought it. So we've had some challenges for sure, but we haven't had to do like a capital call or anything like that, which is good from an investor standpoint. So that was the first deal.
There's definitely some deals falling apart right now too, and we're starting to see some foreclosures, some bankruptcies because of that. The holding cost exceeding the rents ultimately, right?
Yeah, it's one of those things where 2021 was such a hot market. Like I said, there was a lot of pent up demand from people not doing a ton of deals in 2020, and you had a lot of people having FOMO, right? Fear of missing out on an opportunity, and I know a lot of people that bought deals then that they're feeling the pain, right? They're feeling more pain than what I'm experiencing with that deal, which is lucky for us. I've known a few folks in other syndication groups that, to your point, have felt more pain where they've had to do capital calls or they've had to bring in another investor and essentially recapitalize the entire stack. So, so I don't think the industry is out of the woods yet. There's a ton of variable rate debt that is, typically they're on a 2 to 3 year term with a bridge lender, right? And so, we're rapidly approaching refinance times, and if your debt service ratios aren't at where they need to be or your occupancy isn't where it needs to be, you're not going to be able to get, long-term Fannie Freddie debt. So you only have a handful of options, and sometimes you don't want to go down certain paths. I think we're in the middle of it right now. I don't think that, assuming interest rates don't continue to tick up too much over the next kind of 6-8 months, I think there's still going to be some pain out there, which could be a good buying opportunity. I'm definitely still looking at deals because if you can make a deal pencil in this market, if you're doing fresh debt, not essentially doing an assumption of the existing loan, but if you can make fresh debt work, odds are in 2 to 3 years when you're going to refinance, it's going to be a lower interest rate than you're in right now, right? So it should be a home run if things go to plan. So I think if you can find a deal now, it's awesome.
No, agreed. And there's going to be more and more blood in the streets as we go, and lots of opportunity there, for sure. Yeah. So have you done any deals since as a lead sponsor?
Yeah, I haven't. So with recruiting in 2020 was slow, very, very slow. But then just like real estate, 2021 was like gangbusters. I had more business than I could possibly handle. So my priority shifted to focusing on the recruiting side. And from a real estate perspective, I was still looking at deals and analyzing them, but I was spending more time trying to build my investor database and investor network so that I could participate as a co-GP and help to raise some money and do some investor relations and all of that, just because I can make a lot of money from recruiting and then invest that into real estate. So my time commitment shifted a little bit where I was, kind of balancing both. But so no, I have not been the lead. I have not found a deal. I've participated as co-GPs on 4 other deals. So I think right now we're co-GPs in 5 deals across 3 markets, I think. Jacksonville, Florida, Fort Worth, Kansas City. I feel like there's one more, but I think it's just those three markets that we're co-GPs on deals. I think it's over 1,000 units, or no, it's over 650 units at the moment. So yeah, it's been a lot of fun. It's been, the thing that I enjoy about the capital raising and participating in these deals is I never had exposure to real estate as an investment vehicle at any point in my life until 2018, right? And so if I can bring an opportunity to somebody that may be in that same situation where they're, they would love to have a little bit of passive income to help offset the expenses that are going up in their household, right? And so if I can do that by just explaining to them what the power of real estate is, not only from, a passive income standpoint, but a wealth generation standpoint. Obviously, there's tax incentives and all of this stuff. So that's where I kind of enjoy it. I'm not a salesperson by any means. I don't sell people on deals and why they should invest. I explain to them the opportunity, and if they feel like it's a good investment for them, then we can rock and roll and move forward. But that's what I really like. I started my own podcast to do that, to share the message. So I applaud you what you're doing and trying to get the message out there to help people that may not have as much exposure to investing in alternative assets outside of the stock market than the next person. So yeah, that's the part that I really like about it.
I'm with you, man. I wish there's such a gap of knowledge and, among so many people that are just kind of stuck in their W-2, especially with the golden handcuffs, their high paying W-2 job. And they're just slowly watching their 401k tick up and then drop dramatically.
Yeah.
And, some weird economic situation happens in like Greece or whatever. And no idea about these stable alternative investments, that.
Yeah. I mean, people talk about the security of a job, right? And, I've experienced and worked in-house as a corporate recruiter for startups, for large Fortune 50 companies and kind of the 300 to 400 employee companies. And, it may feel great getting a paycheck every other week or every Friday whenever you get paid, but ultimately you're an expense on somebody's Excel document, right? And so if they need to make their quarterly numbers for the street, you may be on the chopping block, no fault of your own. So, right. I love being your own boss has its own challenges and own nerve-wracking experiences and all of that. But I literally if I put more effort in, I can make more money. Whereas if you put more effort into a job, you're typically going to make the same salary. So, for sure. The security that people feel in a job sometimes is a false security, because you could walk in on a Monday or a Friday and they say thanks, but no thanks. We're going to have to let you go. And then you're on the market like a lot of people are right now, which is unfortunate. And their income stops, right? Once let's assume they get some severance, their income stops. And, I talk a lot about like financial foundation and having, the security blanket of having, 3 to 6 months in a nest egg, right, of cash. But also if you have a couple $1,000s of passive income coming in from some of your investments, how amazing would that feel if you lost your job, but you're like, oh wait, I've got a couple thousand coming in from passive investments that I've made. Maybe that doesn't cover your full, lifestyle expenses, but at least it doesn't have you dipping into savings as much, right? So,
right.
So I think that's the part that I'm excited about. Like I was a big saver. I was always a saver. I still save today. And when the economy starts to fluctuate like it is right now, people hoard cash, which I'm not opposed to. I've been not investing as much as I probably should be at the moment. But it feels good to have a little bit of money in the bank, unless it's, Silicon Valley Bank, but what happened to them a few weeks ago. So,
yeah.
As long as you're, making sure that you're diligent and looking at options, I think the real estate space, whether it's syndications or multifamily or, even single family or short-term rentals, it's a great place to be and, generate some income and, also generate wealth.
I mean, in 5 years, you went from reading a book, right, being largely like most people are, completely ignorant of like even what a syndication is, who the heck buys these 600 unit apartment complex,
Yeah.
right? You have no idea. You just think it's like the richest of rich people, not
Right.
just like you and me, like a whole bunch of yous and me's out there. And so in 5 years, if I heard that correctly, you're involved in 600 doors now, right?
Yeah.
Like,
Yeah, as a general partner, we've got more from a passive standpoint. Like I said, we've invested in other deals just passively. But yeah, from a general partnership standpoint, I think it's like 652 or something like that.
and what about from your passive side too?
What's that?
What about from the passive side too? That you're in your
I think
LP.
we're
How many
over
doors are there?
1,000 in that space. So we're steadily growing. Like there's a lot of people out there that grow way faster than what we did, and that's fine. That's their journey. I'm a risk averse person by nature, so the thought of the first time I put $50,000 in cash, not a self-directed, but $50,000 in cash into a deal. I had some heart palpitations when I was clicking that wire submit button, right? So
Sure.
but then once you start to see some income come in, and you realize like, okay, yes, I put this into let's call it a 5-year hold, right? So you're locked up, it's non-liquid for 5 years. But, assuming things go somewhat the plan, you're going to get some trickles of cash flow in the meantime, right? And then you're going to hopefully get that $50,000 back plus some friends. And so then you take all of that money that you've accumulated and put that, call it 75. If their numbers are right, you're supposed to double your money, right, in 5 years. So let's say you get between 75 and 100,000. Well, now you take that and put it in another deal, right? And then it just compounds and compounds.
Yeah.
And
Yeah.
like, yes, real estate is not a get rich quick scheme. You're not going to, my $50,000 investment at first deal is not going to turn into $1 million tomorrow. But it also theoretically isn't going to go to zero tomorrow either, right?
It's get rich for sure.
Yeah. Yeah.
It's not get rich quick.
It's
get rich.
But, I've got, when we started, and I'll call it probably around like 2020, when we got into the syndication group, I was like, okay, I've got, I think it was an 8-year plan, because I wanted, by the time I'm 45, I'm like, okay, I want to have enough passive income that it covers our living expenses. So that gives us the freedom to do the type of work that we want with whoever we want from wherever we want. So, people talk about financial freedom, and, I think there's a few layers of financial freedom, but that's kind of level 2. If I'm like, covering my bases, my lifestyle really doesn't change, but I don't have to be actively working, actively recruiting, or actively looking for deals. Like there's enough coming in that supports our life. And then, imagine if you could say I'm quote unquote retired by the time I'm 45. Like everybody would love that,
Would.
So yeah, so that's kind of the plan that we're on. Again, it's not I wish it went faster. I wish I had a lot more money that I could just throw into more deals. But you work with what you got and you keep moving forward. So it's been a fun journey.
Well, the nice thing is it is more of like it's not really linear growth with real estate. It is exponential, where it's like flatter on the bottom in the initial years, and then at some point you're up here, and you can literally, you're just throwing, there's not enough deals for your money,
Right, and that's
what it turns into.
That's the theoretical long-term fun part, right? Is like you just become an investor. You just have this nest egg of money that is generating you income, that if once a deal sells and you get that money back plus some friends, you have to figure out what to do with that. So that hopefully in a few years, that's my biggest concern is, where do I now put this chunk of money, right?
Yeah,
and it's like,
right.
okay, I need to find a deal. And that's part of what I'm doing now, is building the relationships with the more active deal hunters out there, because there's 1,000,001 syndicators out there, which is good and bad. There's no certification or credentials that you need to get to be a multifamily syndicator.
Right.
Same thing with recruiting. There's a ton of recruiters out there, a lot of bad ones. And same thing with syndications. Like there's a lot of people that I lost deals to, and I don't know who they are, but I know there's obviously people that won deals that I bid on, that I was invested final on, and I may have lost out on a $15 million deal by, call it $1 million or $2 million. Well, that was in 2021. Those are the people that I'm like, okay, well, let me know when that deal is going to come back around, because if they underwrote it similar to how I underwrote it, they're not going to be able to achieve their numbers because
No,
they
they overbid.
overpaid and maybe they're undercapitalized. And so, going back to what we talked about earlier, I think there's going to be some blood in the water here in the next handful of months. So, yeah, I'm a patient. I'm a very risk averse person, like I said. So my underwriting is conservative, which conservative is the most overused word in the syndication world. Everybody's underwriting is conservative. But I'd rather lose a deal than buy a bad one. So
I'm with you, man. I'm with you. So what's are you what's on the horizon? Are you strictly sticking to multifamily? I heard you mention single family short-term rentals as well. Are you just kind of keeping your eye open for whatever? Are you considering fund of fund structure? Like what are you looking to do next?
Yeah, I'm in this point right now where multifamily is a little bit in flux, right? And so I'm starting to look at short-term rentals as an active investor. So I'm looking at a few myself. I've talked to a few people that do short-term rental management because obviously I don't want to have to manage the properties and all of that fun stuff. So I'm starting to peel back the onion on short-term rentals. As I mentioned earlier, I'm talking to other operators, other syndicators that syndicate other asset classes. So hotels, self-storage. I don't love single family necessarily. Just it's slower in my mind. So I haven't really dug into like just buying a house and then renting it and then buying another house and renting it. But if somebody has like a portfolio and they're like, hey, we need to exit, and then you can buy a portfolio of single family, that's similar to like a multifamily deal, right? Assuming you're in the same geography. So I wouldn't be opposed to that. And the other thing that I'm looking at is smaller multis. So call it 15 to 30, 40 units, which typically a syndicator isn't going to go after because they're too small. And an individual, typically those are bought by doctors, people that have a lot of money, and they just need to put it in some type of investment. So I have a few people that would be like general or joint venture partners with me on that, where we would just buy the asset, and that would be like a very long-term hold, not a syndication. We wouldn't think about flipping it in 5 years. We would more or less look at that as like, that's just going to be cash flow for the next 10, 20 years. So I've got my eyes open for a few of those in specific markets as far as that goes. So yeah, I'm keeping my options open. I still think syndication is great. I'm still going to be a passive investor in that for sure. I'll still raise money on those deals when they come around and help to do some investor relations and all of that stuff on that. But yeah, I'm looking at other assets for sure.
Awesome, man. Awesome. Well, excited to continue to see your journey, man. And over the coming months and years as this market keeps shifting. That is, I can't, I mean, you played it down so humbly, but like 5 years, 1,600 doors that you have an ownership interest in.
Yeah.
That's what's possible in this world. Right. And moving into the problem of not how do I get the money to buy it to be a part of this, but where do I put my money to continue to be a part of this, man? That's awesome, man. So thanks for coming on and telling your story.
Yeah, no, I appreciate that. Yeah, and that's we're actually in the midst of where we put the money from our first deal that sold, because we've only had one go full cycle. So we got some money back, which was great, and it's in the self-directed IRA just sitting there. So now we're like, that's why I'm looking at all these other operators to be like, okay, I've got some cash. Where can I put it? So
for sure.
It's a good problem to have, but it is a problem. You need to deploy that capital so it's growing.
Absolutely. If someone wants to work with you in any capacity that you mentioned, giving you money or finding you deals, whatever, right? What's the best way for people to get a hold of you?
Yeah, I'm on LinkedIn a lot. That's where I live. My recruiting business is Hire Tomorrow, so if anyone needs any help hiring people, I'm always happy to help. But our real estate website is greatventurecapital.com. Easy way to go find me there. But LinkedIn's the best. Just search for me and I'll come up. I post a lot about recruiting. I post a lot about real estate. So, and I've got my own podcast. So check out Work Hard, Invest Harder podcast. I'm really appreciate you having me on for sure.
Absolutely. Cool. We'll have to do it again. Maybe I can stop by your show sometime.
Yeah, absolutely. For sure.
All right, Justin. Well, thanks again, man. It's a pleasure having you.
No worries. Thank you.